On December 21, 2020, Robert Breedlove discussed money, Bitcoin and economics with Michael Saylor. It's a 1 hour long talk and I'm sharing the 3 things in this video I've learned from their conversation I found most important. If you're interested in listening to the full talk yourself, I've added a link to the YouTube video in the description below. And for those who are not familiar with Michael Saylor, Michael is the CEO and co-founder of the software company MicroStrategy. He made big headlines when he announced that his company MicroStrategy bought $250 million worth of Bitcoin in July 2020. They now own somewhat around 70,470 Bitcoins in total. So the first of the 3 things I wrote down, Michael Saylor says, is that money is energy. So money is energy. And seeing money as a form of energy is hard to wrap your head around initially, as I may speak for myself. According to Michael, the challenge we humans face is storing energy, transmitting energy across time and space, and transporting energy geographically, from New York to Tokyo, for instance. Michael believes that Bitcoin is the best form of energy nowadays that tackles these challenges best. It's the first time in mankind we found a way to channel energy with no loss, he says. And to paint you a little picture, let's take a power grid as an example. First off, a power grid aims to generate electrical energy to provide people like you and me with electricity. These power grids usually run on fossil fuels or nuclear energy. With a power grid, we channel chemical power into electrical power. And by doing this, we lose around 35% of the energy in coal or fossil fuel. And this is the part where Michael is hyper focused on, I feel. He compares the lost energy with inflation you have in a monetary system like the dollar. Coming back to the power grid, to transport the electricity to people's homes, we need to move the electrical energy over a high voltage line. A high voltage line can only move up to around 500 miles. That's about 800 kilometers. This is an example of the earlier mentioned challenge of transporting energy geographically. And by moving electricity like this, you will lose about 2% of it. So the next step is that the voltage number needs to step down, explains Michael, to make it into people's homes. And by stepping down the voltage number, you will lose another 4% of the energy. If we had pure 100% energy at the power plant, we lost 6% of it by only putting it into people's homes 250 miles away. And there's no way you can send that same energy 2,000 miles away or even further. That's not possible with the current technology we have. You cannot move energy from New York to Tokyo, for instance. And the next problem is that you need to use it immediately when the electrical energy arrives at your home. There's no way you can store it. We don't have a battery to store our electrical energy in our home. And let's say we do place a battery in your home, Michael adds. A good battery loses 2% of its energy per month, meaning 24% in 1 year. In other words, 24% inflation in just 1 year. Try to leave your laptop on standby for an extended period. It will lose its battery life within a week or so. And this is just one of the examples Michael mentions in his talk with Robert. He also discussed the same principle with gold and the challenges gold has with storing it, transmitting it across time and space, and transporting it geographically. So the second thing I found necessary to write down was that Michael says one should compare Bitcoin to gold. According to Michael, Bitcoin critics criticize Bitcoin because it costs 30 minutes and $5 in transaction fees to make a transaction. Who will buy a cup of coffee if it takes that long to transmit your Bitcoin? Furthermore, who will pay for a $2 coffee if it costs $5 in transaction fee? Well, here is where the critics are wrong, says Michael. If I wanted to move $100 million worth of gold, it would cost me around $250,000. And how long is this gonna take me? A week? A month? Physical gold is not fast enough and way too expensive to transport. If you want to move $100 million worth of Bitcoin, you can do so within 30 minutes instead of 30 days. That's 1,440 times as fast. Furthermore, the transaction fee is $5 instead of $250,000. That's 50,000 times cheaper. And the third and the last thing I wrote down is Michael's thoughts on the challenges of storing $100 million worth of something for over 100 years. Michael shares 2 examples. And in the first example, we're storing 100 million US dollar bills in a bank for 100 years. In the second example, we're using $100 million worth of gold. So The first picture he paints is about storing $100 million in a bank to let it sit there for the next 100 years. So if you have an average inflation of about 7 to 8% year over year, $100 million will be cut in half every 10 years. If you do the calculation, you will only have $8 million left at the end. Michael adds that we didn't even consider hyperinflation. Seeing these $100 million as energy instead of money, you see the dollar loses 93 to 99% of its power within 100 years, depending on the inflation rate. It's somewhat the same in the first example I gave you with the electricity at the beginning of this video. You cannot store electrical energy since a good battery loses roughly 2% of its energy every single month. And as said before, but I will repeat it since that's probably the central message of this video, according to Michael, the challenge we humans face is storing energy, transmitting energy across time, and transporting energy geographically. So the second example he gives is about converting our $100 million into gold. Michael explains that if you buy $100 million worth of gold of JP Morgan, for instance, you will have them store it in their vault, since you cannot carry around 1,600 kilograms or 3,500 pounds with you easily. According to Michael, the custody fees will be around 20 to 40 basis points per year. And if you don't know what a basis point is 0.01%. So in other words, you will be paying 0.2% at the minimum per year for storing your gold in JP Morgan's vault. 0.2% of $100 million is $200,000. And then you have the miners who are mining gold, or in other words, adding new gold in circulation year over year. And that's around 2 to 2.5% according to Michael. And with gold you also need to add the counterparty risk and the fracking risk. And I'm not entirely sure about this, but I think Michael means that your gold isn't totally safe by counterparty risk. Meaning, if you tried storing your gold 100 years ago, you probably wouldn't have any of it any longer. Try Googling Executive Order 6102. Executive Order 6102 is an executive order signed on April 5, 1933 by US President Franklin D. Roosevelt. This new law forbade people to hold gold coins, bars and certificates for every American. Every person in America needed to sell their gold before May 1, 1933 to the Federal Reserve in exchange for $20.67 per troy ounce. How crazy is that? Even worse, if you didn't deliver your gold to the Federal Reserve, you could receive a penalty of $10,000 and or up to 5 to 10 years in imprisonment. And $1 in 1933 is roughly $20 today, meaning it's a $200,000 penalty. Since 1974 you can have gold legally again in the US. So that's roughly 40 years when gold was illegal. Furthermore, coming back to Michael's example of storing $100 million worth of gold for 100 years, if you tried doing that 100 years ago in the US, you would have lost it all in 1933. If you tried doing it in another country, there's a good chance you lost it all by World War I or World War II. Only a couple of banks survived during those times, Michael explains. And then you have the fracking risks with gold. Michael explains fracking risks at the risk that there can be mined more gold than usual if you spend more money to develop new technologies to come up with better ways and faster ways of finding gold. When I Google fracking, it says the following. Fracking is the process of drilling down into the earth before a high pressure water mixture is directed at the rock to release the gas inside. Water, sand and chemicals are injected into the rock at high pressure, which allow the gas to flow out of the head of the well. Michael says people have a tendency that when you tell them they're about to run out of something, they reprioritize. They think a little bit harder and they come up with an innovative solution. And this is what happens with fracking, Michael explains. If you can raise new capital, we can develop a new chemistry and implement fracking to double the amount of that something you're trying to get. Michael explains that it was conventional wisdom that we generated 5 million barrels of oil per day for like 40 years. And then there was a crisis and the oil price went up and high enough to let people come up with a better way of fracking oil. Michael explains that he watched it happen. All of the big investment bankers raised billions of dollars and they invested in these fracking companies. And the next thing we read in the news is that we had too much oil. A few years later, we are at the point of 10 million barrels of oil per day. If you invest $100 billion into anything, you will invent something new, says Michael. And he probably believes there is a risk of smarter, stronger and faster technologies that disrupt the gold supply and therefore pulls the price of gold in a downward spiral. Michael says that gold, like fiat money, like the dollar, will lose 95% of its worth, or energy as he states it, within 100 years. And in my opinion, he didn't elaborate on that statement that gold loses 95% of its value. But maybe I missed it or misunderstood something. When Googling the gold price history, I found an article from thebalance.com stating that an ounce of gold in 1929 was priced at $20.63. If you consider the dollar's inflation rate, that same $20.63 was worth $307 in 2019. By August 7, 2020, gold reached a new all-time high record of $2,062 an ounce. That's an increase of more than 10,000% in price per ounce if you don't consider the dollar inflation rate. If you do consider the dollar inflation rate, then it's an increase of 571%. So if history shows us that the price of gold went up in 90 years, why would it suddenly lose 95% of its value in the upcoming 100 years? So again, I'm not sure what Michael means by losing 95% of the value of gold in 100 years, but maybe he's pointing towards the counterparty risks explained earlier. So this was my summary and notes I took from listening to the conversation between Michael Saylor and Robert Breedlove. I leave a link to the complete discussion in the description below if you're interested in listening to the full interview. If you like me creating these summaries of these long in-depth talks, please make sure to click that like button, so I know whether or not I should continue making such videos. Also make sure to leave a reply and let me know what you've learned from my notes, if any. Also make sure to subscribe to my YouTube channel. I'm publishing 2 new videos per week. And lastly, I've added a video here, which is another really interesting 10-minute summary of a 2.5-hour in-depth interview with billionaire Michael Saylor. Also, if you're interested, please check out the description for my other videos about me and my entrepreneurial journey. Thanks for watching my video and hopefully we'll meet again.